Chapter 3, Lecture 3, Importance of Financial. Why ratio analysis? Why is it important for us to be able to divide this by that, subtract this by that, or add this plus this? Well, there's three reasons specifically why ratio analysis is important that the book points out that I think is pretty accurate. One is investor and security analysts. You want to make sure that your investors are getting the best bang for their buck if they're wanting to put money into your company or your organization. So ratio analysis is really showing the investor that yes, this company is worth investing in. And there are different numbers in financial reporting that they will look at to analyze that to be able to say, yes, I want to put money in XYZ company. Security analysts are also very important. Analysts on Wall Street specifically because they're wanting to crunch the numbers themselves to do a ratio analysis on a specific company to where they can rate the company saying, yes, this company's stock is a buy, or this company is a sell, or this company is a hold, because even though they might not show the strongest numbers within the industry, they are doing well. It's the industry is not doing well. So those are one reason why ratio analysis is important. A bank will constantly do a ratio analysis on a company to make sure that it's solvent. Because if a bank is concerned that it won't get paid on some of its long-term debt and obligations, then it will call in a loan and essentially protect itself. And for the company itself, the last thing, if they especially need an operating line of credit to keep their business going, is they do not want the bank to call the loan. So it's important as a financial analyst that you understand those. Long-term creditors, if venture capitalists or people that are known as angels, which are people with a lot of money that want to put investments in specific businesses, they will want to know ratio analysis and will do their own ratio analysis to make sure that your firm is doing exactly what they want you to with their money to where they can continue investing in it since they have a controlling interest. And again, this is just a breakdown of why they're interested. Investor and security analysts are profitability ratio focused, liquidity and debt utilization focused, bankers, liquidity focused, and long-term creditors, debt utilization and profitability, as I just stated on the previous slide. The DuPont system of analysis is another analysis you can take. And the definition is it's a method of performance measurement that was started by the DuPont Corporation in the 1920s. With this method, assets are measured at their gross book value rather than at net book value in order to produce a higher return on equity. It can also be known as the DuPont identity. You might get a few test questions on this. Explanation is it's an analysis tells us that ROE is affected by three things: operating efficiency, asset use efficiency, and financial leverage. This is the formula for the DuPont system of analysis. This will be made available. Make sure that you know this formula because you will have a test question on this most likely, and it'll probably be covered on your homework. The ROE is the profit margin times total asset turnover times the equity multiplier. And as you can see, here's a breakdown of the whole formula on these next three bullet points. Example of the DuPont analysis is Walmart and Abercrombie. You can see on here that profit margin is 3.4% for Walmart, 5% for Abercrombie, times the asset turnover equals to the return on assets plus 1 minus the debt divided by the assets, which is essentially owner's equity divided by assets and gives you a return on equity. It's just another way of calculating return on equity. Here are some application of ratios, and once you get the number, here's what you do with it. What you do with the ratio number once you have calculated it is you do a comparison. You compare it to the industry, to historical numbers of ratios that you've used in the past from previous years, and you use your ratios compared to competitors. Here's an example of industry analysis. You see the Saxton company here, they have a profit margin of 5% compared to the industry average of 6.7%. As you can see, our conclusion is that it's below average on the industry average, and want to look at understanding why is it that way? Why is the return on equity above the industry average? Why is the liquidity good, doing above the industry average? Why is the debt to total assets doing better, saying that maybe it needs slightly more debt financing involved with that? So these are all questions you would ask when maybe looking at doing a comparison against an industry average versus the company for a ratio analysis. Historical example you might look at is specifically the profit margin versus the industry. Saxton has not done well from 1998 through 2005 in the profit margin category. However, in 2006 to 2008, 2009-ish, Saxton actually outperformed the industry in profit margin. Understanding why was that? But now Saxton's behind in 2010. So just another example of historically. Total asset turnover. Saxton has been higher than the industry average, and understanding why is that? Compared to competitors. Looking at the profit margin, assuming Saxton is a computer company versus IBM, versus Dell, versus Apple, and just really taking that comparison into play. That is end of chapter 3, lecture 3.